All right, let's jump right in. Today, we're diving into this really fascinating story of reinvention happening in the world of finance. It's kind of the classic tale, right? The old guards are learning new tricks, and the young disruptors, well, they're having to grow up and fast. This quote just nails it, doesn't it? It perfectly captures the whole theme of our story today. You either adapt or you become a relic. We're going to look at three different companies: an incumbent, a disruptor, and an elder statesman. And each one is facing its very own blockbuster moment. Okay, so first up, let's talk about our incumbent innovator, Fiserv. Now, this is the established giant, the absolute bedrock of the financial system, and they are making a move that is, frankly, surprisingly modern. So who even is Fiserv? Well, think of them as the essential plumbing of the financial world. They're a massive $90 billion company that powers the payment systems and banking infrastructure that a lot of us use every single day. They are the textbook definition of an incumbent. Now, here's where it gets interesting. Fiserv is getting into stablecoins. But before we go any further, let's just make sure we're all on the same page. A stablecoin is a type of crypto, but it's specifically designed to avoid those wild price swings you see with something like Bitcoin. Its value is tied or pegged to a stable asset, usually the US dollar, so one stablecoin pretty much always equals $1. Simple as that. So, here's the play. Fiserv went out and acquired the cash management part of a company called StoneCastle. Why? Well, because StoneCastle has this gigantic network of bank deposits, which is the perfect, rock-solid foundation for building a stablecoin that regulators will actually approve of. See, this isn't about wild crypto speculation. It's about integrating new tech into the old-school, trusted financial rails. And just look at what they're planning to do with it. This is not about trading meme coins at 3 a.m. Nope. Fiserv is targeting the, boring but absolutely massive applications: managing corporate cash, settling payments between businesses, and paying out merchants. The goal here is super simple: make moving huge sums of money way faster and way cheaper. I absolutely love this analogy from the source material because it just hits the nail on the head. PayPal launched its own stablecoin, but it still felt kind of niche, like a hot new artist. Fiserv? They are aiming for total market domination. They want to be mainstream, trusted, and basically everywhere. So the big takeaway here is this: stablecoins are officially graduating. They're moving out of the crypto niche and becoming a serious financial tool. And Fiserv, the ultimate industry insider, is positioning itself to be the trusted, regulated grown-up in the room that makes it all happen. Okay, so that's the incumbent. Now let's switch gears and talk about our disruptor, SoFi. They started out as the cool new kid on the block, but now they're being forced to do this kind of awkward backtrack as they mature. And this just perfectly illustrates how strange their journey has been. So when a brokerage offers options trading, they typically start you at level 1, the safest stuff. Then you graduate to the riskier levels. SoFi? Yeah, they did the complete opposite. For years, they only offered the riskier products and are only now, finally, going back to add the most basic, level 1 stuff. So why the backwards rollout? Well, there are a few reasons. Of course, customers were asking for it, and it's another way to make money. But honestly, the biggest reason is that it's a signal to regulators. By filling this gap, SoFi is trying to show that it can responsibly manage the entire product ladder, not just the flashy, high-risk parts. This quote just perfectly sums it all up. SoFi basically served up the exciting stuff first to get a ton of users, but now they're realizing that to be a sustainable, long-term company, they need to have the foundational, healthy products on the menu too. So here's the bottom line on SoFi. After years of just serving dessert, they're finally adding some vegetables to the plate. It is a classic sign of a disruptor being forced to mature, because sooner or later, regulators like the SEC are going to come by and check what's on your plate. And for our final character, we have Jack Henry. We're calling them the industry elder. I mean, this is a true veteran of the fintech world, founded decades ago, and now they're trying to stay relevant by basically buying a startup hoodie. Just look at this timeline for a second. Jack Henry has been around since 1976, providing the core software that community banks literally run on. Now you fast forward to today, and they're acquiring a modern, cloud-based startup. That is a huge, huge leap from their traditional business. And this really shows you the culture clash they're embracing. They're moving from the old world of, clunky login portals that look like they're from 2003 to the new world of slick apps and embedded finance where financial services are just built right into other apps. They're essentially buying their way into the future. And this is the existential threat that is facing every established player out there, not just in fintech, but in every single industry. Jack Henry gets it. Standing still is just not an option anymore. You have to evolve, or you'll simply become obsolete. So, the really crucial point here is that this one acquisition signals a major trend. It proves that even the oldest, most conservative players in finance recognize that the future is built on the cloud, and they are willing to pay up to make sure they don't get left behind. So, we've seen an incumbent, a disruptor, and an elder, all making these massive moves. Let's try to pull it all together and see what this great fintech remix really means for everyone. What we're seeing is just this great blurring of the lines. You've got the incumbent, Fiserv, innovating like a disruptor. Then you've got the disruptor, SoFi, backtracking to act like a responsible old-timer. And the elder, Jack Henry, is buying a hoodie to stay young. The old roles and labels, they just don't apply anymore. Which, of course, leaves us with this final, big question to chew on. As all these roles continue to merge and blend, who ultimately comes out on top? Is it the established giants who have the trust and the resources to adopt new tech? Or is it the agile newcomers who are being forced to mature and play by the rules? It's definitely something to think about. Thanks for tuning in.